Today, I have the great pleasure of interviewing Larry Schiavi, who's the National Sales Manager with HSBC, and Larry's located in New York. Larry, before we discuss your professional career, most of the contemporaries that are going to listen to this, they always want to know a little bit about your background, where you came from, and how you got into the business. And so how about a little background, and then we'll get into the mortgage side of the equation.
Sure. I've lived in upstate New York my whole life, John. I went to school at a Jesuit college here in Buffalo, Canisius College.
I went to Georgetown.
Great.
Understand those Jezzies.
Exactly. Received a bachelor's of Bachelor's of Science in Finance in 1985. Was married shortly thereafter. Wasn't quite sure what I wanted to do. Answered an ad in the classified section of our local paper here in Buffalo, New York, and the rest is history. I started with a small mortgage company that was about a year old in 1986.
Was this your first professional job?
Probably my first real professional job. Sure. I sold mutual funds for about a year. Not quite sure what I was doing at that time, but I think this was my first official job.
And you say you got that off an ad in the paper.
Exactly. Exactly.
When you started off, I'm assuming you started off as a loan officer?
I started off as a loan officer right in the middle of, I think, the modern-day refi wave of 1986. And rode that wave for about 4 months.
Yeah, right. Well, when I got in the business, I got in when it was in the depths of despair, and it was like dying for 6 months.
That was the second quarter of 1986, or 1987, I should say.
Yeah, well, everybody goes through these cycles, and people that have been in this business a long time know that we are in a cyclical business. And as a matter of fact, now we're in a contraction of sorts, certainly with refis having dried up. Did you have any formal training in your first company? Obviously, that's a leading question, but this is what my company is addressing.
Sure. So. It was really a very small company. Again, the company was about a year old, and it was really on-the-job training. We spent a little bit of time in-house. It was a hands-on kind of atmosphere where you'd spend a week with a processor, a week with an underwriter, a week with a closer, a week learning products, and off you went. And
then on to the street.
Exactly.
Not to digress, but, there are two schools of thought when it comes to training people, and the two most famous companies that were involved with it. One was IBM, and the other was the old, I think it was Procter & Gamble that owned them, but it was the Vicks Vapor Rub company, and they both had diametrically opposed ways of training. At IBM, if you sold computers for them, and I did, they put you through really a 4-month training program, no expense spared. Take you up to New York a couple times. Went up to Poughkeepsie,
sure.
And by the time you hit the street, the theory was that you could pretty much do anything. As a matter of fact, in those days, and I'm 56, but in those days, IBM salesmen were the only people that could actually program any computer they sold because the software was free. You just leased it and got all your software free. Which is kind of hard to even understand in today's, environment. The other one was the Vicks Vapor Rub company, and their philosophy was if you walked and breathed, you had a job with them. And they became very famous for it. They would really hire anybody off the streets. You would be homeless and get a job with them and walk in, and they basically gave you a kit, and they got you to a map on the wall, and they said, well, this is your territory. We'll see you in about 3 months.
Sure. I hate to admit it, but I think we were the Vicks Vapor Rub.
Yeah, right.
The mortgage business.
Well, that's right. And as a matter of fact, there's some articles to date this interview. This is taking place in March of 2000. There's a major push, an article in the Washington Post this last Saturday that the NAMB is going to make a push with the concurrence and full support of the MBA, not always easily attained between them, and Freddie and Fannie to license mortgage brokers, loan officers, literally.
I think that's a fantastic idea. You think back 14 years ago now, in 86 and 87, the business was, I think, so much more subjective. And, it was almost impossible to teach someone what they would encounter out in the field. Today, with the advent of the automated underwriting engines, I think, I don't want to say the subjectivity has been taken out of it, but I think it's certainly a much more objective business when it comes to structuring transactions from the origination side, and,
sure.
and it certainly has leveled the playing field a bit from an underwriting standpoint, and to develop some type of certification process or licensing process around the automated underwriting engines is probably a great idea.
Yeah, and I think the other thing,
sales and psychology, and throw that into the mix, and we might have something.
Yeah, and I think the other thing too, and obviously we're digressing a little bit, but that's okay. The other thing too is that this is a form of self-regulation too. They're trying to keep the government out of it and to do everything themselves. And the program is actually very ambitious, probably more than the government would do. So I think it's to be applauded. Anyway, so you had very little training. Did you concentrate on realtors in your business, or were you going after new homes, or?
Yeah, it was primarily realtors. I think then we were a mortgage banker, and certainly the large S&Ls or commercial banks weren't really. They weren't sure if they were in the business or not. They certainly weren't in the FHA VA business, and that's really what a small mortgage banker in upstate New York that would be their niche. I mean, we went after realtors and any referral source really, and it was primarily a government. It had a government flavor to it. We also did obviously conventional loans.
And of course, I would also think too, up in that area where you live, probably those FHA and VA limits in those days were probably rather meager, and so you probably had to really hustle,
A $60,000 loan was a jumbo back then.
You're right. Was there? Let me just ask you something. Was there? I like to call it pain and suffering. Did you go through a lot of pain and suffering initially? I say that because in our business, there is a certain price that you pay going into the deal.
Sure.
Just from a time standpoint, not only because loans take time to underwrite and process and close, but also approaching those realtors. Especially if you look young. It's like the kiss of death.
It was the fear of the unknown. There's no doubt about it. It did help that I did start in the business in that first refi wave. So the first 4 months or so were exciting. I mean, it seemed too easy to be true. Answering the phone, scheduling appointments, making a lot of money, quite frankly, for a 22 or 23-year-old individual at the time. But once rates went up, and at the end of that first quarter, the business became really what it is in a traditional year. And probably much like people who've been in the business for the past 2 years, just got in it maybe in 1998 and have been performing as an order taker for the past 18 months or so.
Sure.
And we're seeing some fallout now in our industry because this truly is what the business is about. It's a purchase money market, and the phones don't ring as much, and you've got to go out and proactively source your business.
I'm glad to hear you say that, and I think when we get into what you're doing now, I think we'll focus, or I'd like to focus a little more on that, because I know I found in my experience of talking to executives, those that really put a major emphasis on refis really do so at their peril, and those that kind of anticipate what's going on and can see this thing coming to an end, and those of us who have been around a long time know that they do. It just takes a couple. In my day, it was a McChesney Martin, but it doesn't take too much to set the markets off, and so I think that makes a lot of sense. Let me ask you something. If we can kind of transition into what you're doing now, you might perhaps tell us a little bit about your company. We're not interested, obviously, in anything that's proprietary today, whether it comes to sales number under the maybe general ranges and whatever. But maybe you could tell us a little bit about your company. I know it's quite large. It's real large, your holding company, and then maybe get into what your market area is geographically, and maybe a little bit about the competition in that marketplace.
Sure. Today the company is known as HSBC Mortgage Corp USA. We're the former Marine Midland, We're owned by the HSBC Group, headquartered in London, one of the largest financial institutions in the world.
Yeah, sure.
The group determined that a global branding strategy was the route they elected to take about a year ago at this time, and have gone about really utilizing the group name in every country across the globe that we conduct business in. I want to say it's about 79 countries, give or take a few. And we've gone through that transitionary process where the name has been changed from Marine Midland Mortgage Corp to HSBC Mortgage Corp USA.
Mm-hmm. How has that worked? I know Marine Midland had their name out there for a long period of time,
sure.
And I think this question really has some value for other people at your level and above that are going through a name transition in particular. Any initial problems?
I think at first there was some thought that we may have been taken over, that there weren't as many people as I would have assumed would know who HSBC Group is,
mm-hmm.
regardless of the fact of their size throughout the global marketplace.
Right.
I think because we changed the logo in 1994 to reflect the group's logo, that from a visual standpoint, there was an assumption that there was some kind of affiliation. But if you just sat back and weren't really cognizant of who the group was, I think the thought of an acquisition or integration came to mind, and especially with what's been going on in our business over the past several months.
Mm-hmm.
Over a period of time, we've certainly supported the name change globally, and particularly in New York, where we're based here in the U.S., with an awful lot of television and radio advertisement as well as print advertisement. So now a year later, I think the word is out, but there certainly was a transitionary period in the first 3 to 6 months,
mm-hmm.
and but I think that's behind us now.
Let me ask you something. In your market area with HSBC, I know you're down here in the Washington area because I know some of the people down here. What generally is your market area? For example, are you a West Coast outfit or?
Well, we're headquartered on the East Coast here in Buffalo, New York.
Mm-hmm.
Our business on the retail side is primarily New York State and contiguous states. In excess of 90% of our retail business is New York. We have a little bit more than 400 bank branches, and we really service the customer in the footprint of the bank. Our correspondent lending business is much more national in flavor.
Yes. Mm-hmm.
We do an awful lot of business here in New York, obviously. We're fairly strong in the Southeast, and I would include Virginia,
oh, absolutely,
North and South Carolina in that mix. We have a pretty strong presence in Chicago and in Detroit, Michigan. Beginning to have a stronger presence in Texas as we've begun to grow that market.
I see.
And we also have some business in California, in Northern California on the West Coast.
So it sounds like you're positioning yourself, at least in the future, to become a national player.
Exactly. We just consummated the purchase of Republic Bank. Republic is
mm-hmm.
located in New York City. Their mortgage corp headquartered in Brooklyn, and the bank headquartered in Midtown Manhattan. And Republic's mortgage business again is more of a correspondent lending operation, concentrated in the boroughs of New York City, as well as the entire state of California. It will open up Southern California for us, which we have in the past not been very successful in sourcing business out of.
Now, my understanding is that your area of expertise is in the retail.
That's correct.
Area as opposed to wholesale or
That's
correspondent
correct.
lending.
I spent I've been in the business now 14 years. I spent my first 12 years in retail and in just about every capacity imaginable. And about 2 years ago, we consolidated all of our production or originations channels under my direction.
Mm-hmm. And how many retail offices do you have now?
Retail, we have about 14 offices. We do have some satellites that report into offices. For example, in Buffalo, we have an office in Jamestown. In Long Island, we have a main office in Melville with a satellite in Center Reach. We also have 3 offices outside of New York State, one in Columbia, South Carolina, one in Charlotte, North Carolina, and one in McLean, Virginia.
Well, I'd like to transition a little bit from kind of the general overall view of HSBC to you, because the listeners, the people who would be interested in listening to this, are people that are either at a level below you, who are regional managers themselves that would perhaps like to be a national sales manager someday, and then also there's other national sales managers who more than likely will be listening in to what you have to say and your advice, and also obviously at a higher level. Understanding that your overall mission is to return a profit and provide growth to any corporation, I'd like to focus for a moment on 2 general areas. The first is what you would expect from your subordinates and how you measure their performance. And I'm basically here talking kind of a direct line to regional and branch managers as opposed to underwriters and processing. And then in a generic sense, devoid of anything proprietary to your current company, what do you think some of the specific expectations for your performance by someone one level higher than yourself?
Sure.
So maybe let's talk about what you might expect from your direct subordinates and how you evaluate them, what you're looking for, and and how they implement what you want.
I think we have a situation here where we almost provide an environment where the individual account execs or regional managers, I should say, both on the correspondent lending side and on the retail side, really run their own business under the HSBC umbrella. We're not at the point yet where we're paying people based upon profitability, but what we're trying to accomplish is to, on the retail side, to provide mortgage or to make mortgage a key core product of the bank branch network. We're attempting to not only service the customer that walks in through the branch or that's directed to mortgage by the branch, we're also trying to bring people external to Marine Midland, or I should say HSBC Bank, into the bank for the purposes of cross-selling multiple products. So from a management perspective, what we're attempting to do is provide superior customer service to those borrowers, both internally and externally. We are looking to develop an external pipeline of business so that the bank can then begin to cross-sell multiple products, make the customer, I guess, what's the word I'm looking for? Make that customer
cross-platform.
A platform, exactly, for multiple products of the bank. We concentrate on relationship selling, being a member of the group. We try to bring opportunities into the bank that normally you wouldn't be able to do if you were a mortgage banker or a mortgage broker, both domestic and international opportunities. So,
some examples of that, specific examples where, and primarily I'm talking about in a managerial level, with you managing your direct subordinates, how you would expect them to gather that business, and I understand perfectly well what you're saying.
It's really what we're asking them to do is become really relationship managers, not only for the mortgage corp, but for the entire organization. We're asking them to reach out to the communities they do business in, be the name and face associated with the mortgage corp, and look for opportunities for not only the mortgage corp to grow, but for the bank in general to grow.
And how would a loan officer, for example, in your company be able to achieve something like that? Beyond going into a realtor's office and doing a VA loan for somebody.
I think what we try to do is to take this huge global organization and break it down into more of a local organization, and we try to partner with those experts within the bank that'll help us achieve those goals. We have a program called Bank at Work, which is an affinity program, affinity lending program, if you would.
That's where I'm leading to.
Sure, where the where they're the mortgage officer as well as the particular bank officer of a specific discipline, will go in and either make a warm call from the mortgage side of the fence. In other words, let's make a warm call on a real estate developer that we've done business with and maybe we've been doing end loans for a while, and let's determine if there's infrastructure financing available or line of credit financing that customer is looking for, and vice versa. On the bank side of the fence, let's bring in a mortgage officer to help cross-sell mortgage products to personnel directors of firms that are already utilizing HSBC services in some way, shape, or form.
When you evaluate, which brings me to my point, when you evaluate your managers, is that kind of what you're looking for, not just necessarily a volume of loans in terms of VA or FHA, but the ability to bring value added to HSBC, the holding company?
We're not where we want to be on that today, John, but that's where we're transitioning towards. Obviously, this business has always been a production-oriented business. And
absolutely.
Our people are paid, first and foremost, the lion's share of their income based upon that production. We've got a couple of stages here to get through. One is production based upon profitable business, not just any business in the door, and I think we're fairly close to getting there. And then the second piece of the puzzle is really compensation based upon a group philosophy, which is called managing for value. And that really is I think, the key to being associated with a company like ours. The global reach that the company has, the opportunities, the products, the services that we provide, that is really what we need to get our people to add to the organization. It's really becoming a multi-product sales force and understanding what the strategic objectives of the organization are, rather than just concentrating on that single loan at 6 o'clock this evening that you need to take.
But if I could be a bit of a devil's advocate...
It's a giant leap, I think.
Yeah. If I could be a bit of a devil's advocate for a moment, I think understanding that and understanding the value added that's brought when you have a large holding company like yours, I mean, the benefits are obvious. Still, you hit on something I think that's fundamental to this business, and I think of interest to the listeners today, and that is, and I have to preface my remarks with saying that I was a loan officer when I started off, and worked my way up to regional manager many years ago. But fundamentally, this is a business of bucks and of bottom line, and I say that not in a disparaging way, quite the opposite. That your loan officers out there are very money, which is what you want. And so I think there is a bit of a trick there to get loan officers to cross-sell products and to bring value added to a company. In the face of them, looking at those numbers where they're getting their half point and their overage and all that other stuff too. I mean, that's the
the challenge certainly is to build compensation schemes that will motivate our people to do exactly what we just mentioned.
Exactly.
And again, that is a very difficult. That's a very difficult proposition. I'm not quite sure that we know today, what the value in terms of monetary value do we get out of cross-selling that customer at the point of sale a first mortgage, a home equity loan, a credit card, and a hazard insurance policy. I think in general we know that that's good, and we'd like to sell them as many products as we can, but can we determine today if that's worth $20 for the hazard insurance policy, or $5, or 3 cents? I mean, we really don't have a great handle on that today, because we're just beginning to get into those other businesses, insurance in particular.
I think if you I think I have can provide a partial answer to some of the listeners out there. A specific example is Pat Casey, who's a regional manager with Cresta in Washington, and he runs about 22 offices. And it's interesting. He worked his way up. He was one of the legendary loan officers in his day. And if I hadn't talked to him about this specific specific thing a couple of weeks ago, wouldn't know it, but he has a list of over 30,000 people that he has either touched, dealt with, sold, whatever, that he has kept in an active contact management program. He gets a letter out there a couple times a year to him and has for many years. And I don't remember, I wish I did, but I don't remember the specific number, but the amount of calls that he gets every week and emails from old customers, people who are referring customers to him, it's really incredible. He literally can't keep up with it. He gets probably 50, 60 emails a day alone. So I agree. I think for loan officers, at times it's hard for them to understand and appreciate the value of cross-selling and building your business and stuff. But
I think a lot depends on your history, where you've come from. I know coming from a mortgage banker, it was disappointing not to be able to service the customer who I may have helped obtain a mortgage for 6 months ago if he was self-employed and was looking for some type of business loan. Certainly I'd have to refer them outside the organization, and you learn who to refer people to, and you learn to improve on the quality of your referrals. But there's something to be said for being able to take that customer of yours and keep him within your organization, refer him to someone within the organization who's not only going to help that borrower out and help you solidify your relationship, but also, again, add value to the organization.
Right. Well, let me kind of probe a little deeper here and kind of try and get away a little bit from the company aspects, which I think are certainly very interesting in today's environment, and talk a little more about you, and kind of looping this around into my original question. What specifically are you looking for in your subordinates all the way down the line, whether they're regional or branch or even loan officers, when you're evaluating them?
I think primarily what you look for, and I like to call it leader of men. I mean, the people who I think are successful in our company, and I think in most companies, are leaders. They're ethical people. They work hard. They are really keep their eye on the big picture. They're not looking only at the short term and what can benefit them next week. But they have the ability to, and it's somehow hard to put your finger on it, but it's almost like a great football coach, a Bill Parcells or a Vince Lombardi. I mean, there's just an aura about some of the real successful people in our business on both the management side and the pure retail sales side. And generally, they're leaders in their community, they're leaders in their organization and their families. And I don't know if that sounds a little corny, but that really is sort of a phrase I've always I've always referred back to when I look at the successful people within our organization, within our industry.
Yes, and I understand that, and it's the main criteria in our business. I mean, let's face it, we're a very entrepreneurial business, and that's why, to a large degree, historically, and no references, please, from your company, but historically, mortgage bankers and bankers, for example, have hated each other's guts, and there's no other way to put it. Bankers, sitting there making 35, 45, 50, or whatever after 20 years, they look at these young kids that are mortgage bankers that are out there cranking 100, 150.
Sure.
And as I say, this is more a historical quote than anything else. And there's always been that tension. But when you evaluate your people, volume does count. Business does count.
And if you look at if you look at the various financial institutions and the acquisitions and mergers that are taking place, you're starting to see, that old bankerish mentality, that accountant mentality, if you will, combined with the entrepreneurial spirit of the insurance companies, the mortgage companies, the investment firms, and I truly think if you can somehow or other build a synergistic company where you are indeed taking the best of both worlds, maybe the expense discipline and the financial power of the banks and the entrepreneurial salesmanship, if you will, of the insurance and mortgage and investment houses, then I think you've got something special.
Yeah, I agree. I mean, it's like Steve Case says at AOL, there's real time and then there's internet time. And if the banking side of the equation could learn more of that internet time, i.e. mortgage banking time, and that entrepreneurial drive, I think they'll come out winners on this, because I agree in the competitive nature of the business today. I think banks, in particular, it will be the credit unions or whatever, they need to act more like mortgage bankers.
Sure.
Well,
look at the national statistics. Who is primarily responsible for mortgage origination?
No
brokers have gotten a bigger piece of the pie.
Almost 80% today.
Every day of the week, every week of the month, and month of the year, and there's a reason for that.
When I started off in the business, mortgage brokers probably didn't have, if they had that, 20-25% of the business. And I know Tom LaMalfa and David Olson pretty well. And I've always followed these statistics, and you're right. Every year it's just leaping ahead, and so it approaches 80%. And there has to be a reason for that, and the reason is service level. And this is perhaps not the time to go into computer loan origination networks, but when you get down to it, there is always going to be a need for that infantry mortgage loan officer in the street, looking at a realtor, looking at that client, and being able to hold their hand and answer their questions. And as I like to say, if an appraisal comes in $1,000 low, who are you going to call in Nebraska?
Yeah, I couldn't possibly agree with you more than the statement you just mentioned. The personal touch, that name, face, that individual who is going to do everything he can to make it better for you, to answer your questions in person at 8 o'clock at night when you get home, not via help desk or via some kind of keystroke, but good old-fashioned telephone or face-to-face communication. I don't think there's a substitute for that.
No, and I've seen many articles. Scott Cooley, who is president of Contour, recently wrote a couple articles on eLoan and some of the other internet loan companies, and his basic premise really fell into a couple of areas. One of them, that the expense of originating on the internet is actually going up quite dramatically. But also the fact that people were scared to death, even paralyzed in some quarters, that they were literally going to take over the world and own the business. And I think there's no question that they have a little bit of a chunk now. They're going to have a bigger chunk as time goes on. But primarily, it still is going to, as long as you're competitively priced, service and being there, looking somebody in that eyeball, that's really where it's going to be, I think, in the foreseeable future. I think maybe some of the market numbers.
I agree with you.
Yeah. Let me ask you something to throw a little bit of a curveball. What do you think that your superiors look for in someone in your position? Not necessarily you, but by extension, obviously.
Well, I think today it's really boiled down to coming up with origination strategies that are the most economical. Being from a retail background, basically investigating and determining, can we do some of the business that we do today, some of the internal business, for example, can we do it more efficiently with utilizing technology via telesales origination sales force? How do we really squeeze the last drop we can out of the transaction, because margins are extremely thin? And I think you've got to be able to look at the various channels that you are bringing business in the door. And in our organization, it's telesales, it's retail, and it's correspondent lending, both broker and wholesale, and determining what is the most cost-efficient manner we can get business in the door. How can we utilize the technology that's available to become more efficient, therefore more profitable.
But they're not looking at you. You don't handle the correspondent side of the business and the telemarketing side. What I'm talking is about when someone who's an executive VP or a president of the bank, when they're looking at someone in your position, are they looking, do you think, primarily as someone who's an implementer, good soldier, get out there, knock them dead, bring the volume in, or someone who maybe has a blend that's a bit creative, can come up with new ideas, new ways, someone who's a hard worker. IBM used to have a saying years ago that, works, in fact, it was their logo for a couple of years, work smart, not hard, and which there's something to be said for that. But what do you think they're looking for when they're looking down at a national sales manager? What do you think their criteria is?
I think it has to be someone who's multi-talented. I think it helps to have walked in, and of course, because I think it's important, but I think it helps to have walked in the shoes of the sales force that's out there today. I think what you're trying what I'm being looked upon to do is to build an efficient, profitable sales organization, and making recommendations. You mentioned creativity. It's determining how can I get that business in the door today more effectively. How can we devise compensation schemes that will motivate our people to enhance the bottom line? I think the business today is a true battle for survival. How do we get our people who traditionally maybe are a little bit selfish and are concerned about the commission on the transaction to go out and sell multiple products that they don't earn near the compensation they earn by bringing a mortgage in the door? I think it's a transitory time. How do we go out and recruit the kind of people that we think are going to be effective in a traditional mortgage banking environment? It's sort of a difficult question to answer because my responsibilities really are multi-channel with telesales and retail and the correspondent side. And because I've been on the retail side and spent the last 5 years at HSBC building that, and we have a fairly aggressive and an experienced staff, a lot of my time recently has been spent in acquisitions and integration activities. But I think that today what's most important is getting your people to think the way a senior manager or an executive manager would at the LPO level, at the loan production office level. Getting them to understand what the real issues in the business are and quite frankly, their profitability today. How do you develop a retention strategy where the loan officer feels that he owns the customer and yet the company feels that they own the customer, and you want to go ahead and offer a special program, but you only offer it through your telesales originations channel?
Right.
And how do you balance that with the expectations of your external sales force? Those are some of the issues. I think there's a lot of channel conflict today, and those are a lot of our time is spent trying to deal with those and develop strategies and originations philosophies that please a lot of different people.
Well, a lot of companies, I think Jack Welch at GE comes to mind. Their whole raison d'etre is to create a little bit of tension, and they feel that through that corporate tension, the best bubbles up. And I think mortgage bankers in particular, they really have a leg up on the business just historically, because historically they were the ones that had to get out there and scrounge for the business. They were the ones that worked on full commission. If you didn't get a deal, you didn't eat. And getting into the business, you got real lucky. But for every lucky story, there's a lot of horror stories of myself. And actually, I had a pretty good transition. But there's a lot of people out there. They have to put in that 4 or 6 months, and it really can be quite cruel. And but nonetheless, I think it makes for a better performer and a better employee, and certainly lays the base for someone who can stick it out. Somebody who's much more successful.
Yeah, I think one of the keys in a management position, and regardless of if you're a national sales manager or you're an LP loan product, we call loan production offices, LPOs. That's the acronym we use. That next layer has to be, and again, it sounds a little old school, but that next layer, once you develop that management team, that you know that tomorrow if you got hit by a car, you've got 4 or 5 people who can replace you. I think that's when you've built a successful organization, and that's what I've tried to impart upon the people who work for me. There's out of the 14 or so, there's certainly 4 or 5 of them that are as good of regional or territory managers that you're going to find. And if something happened to me tomorrow, we wouldn't skip a beat by promoting one of those people.
Actually, you just hit a point that's one of my favorites, and I think this will resonate with others who are listening. And that is, I think one of the hallmarks of someone who is not only secure in their position, but really knows and understands the position, is to really go out and hire people and look for people that are better than you, and not be afraid of it. It's easy to say that. It just sounds so smooth and, like, well, who the heck wouldn't agree with that?
Sure.
But, of course, in real life, that's not the way it always happens. And
I think it shows a bit of confidence, and I think it shows a little bit of insight into this business. You cannot be successful in this business managing in an office, in some corner of the U.S. when you've got people all over the world, all over the United States that are trying to originate loans, either retail, telesales, or wholesale. You have to have people out managing those regions who understand the business, who understand the philosophy of the organization, and who really, as you said, can perform your job in some cases better than you can.
Right.
And once you get to that point, you sit back and relax, and then next week one of them leaves, and you start all over again. But that's the toughest part of the business, is getting it just right. And once you get it just right, it usually doesn't last forever.
Well, that's the way that's the way this business is, and in fact, that leads me into an area that I do want to get into, and that is what you look for when you're hiring people, whether they be a regional or branch manager, or you're not too involved with loan officers now, but you certainly the direction comes from you.
Sure.
What are you looking for? Obviously, a successful track record.
First and foremost, you're looking for someone who is ethical, who is honest, who has some type of business acumen, finance background. You're also looking for someone who's a risk taker, someone who doesn't ask you, in the second or third minute of the interview is what is their base salary? How much of this is really guaranteed? And again, maybe it's because of the background that I grew up in. But you're looking for people who have an ability to take risk, who are competitive, who aren't overly concerned about working in a variable compensation situation. You're also looking for people who want to know what's next after I accomplish, all of these things we've just discussed in this office in, downstate New York. Where do I go from here? What is my next challenge? What is my next opportunity? That's really what I look for. And again, I go back to that leader of men, and it's just something. It's an aura. It's like if you've ever walked onto the campus at West Point. There's just sort of a feeling you get when you walk through an historical site like that, and you feel something that is a little bit different, and that's almost what you're looking for. What I look for when I'm sitting down with a candidate to manage an office. I mean, is this someone who can lead people, who is an important part of the community they do business in, who's involved in other activities other than just their business? I mean, are they family people? Et cetera, et cetera, et cetera. It's sort of a long-winded answer, but it's not
very
easy
basic.
To say. I need a BS with a master's in psychology and 12 years in the business, originating $10 million a year. It's not that easy.
Yeah,
it's not that easy.
I know when I was at a branch manager level a long time ago, that you were always, you're right, you weren't necessarily looking for that guy that maybe had that doctor or MBA. Better the guy sold door to door, and sold cars or whatever. Got out there in the street, got a little bit dirty, and knew how to close.
And on the management side, John, you have to find people who understand that you can't just manage these, highly competitive, aggressive salespeople. You do realize you need people who are smart. They have to understand that, especially in our business, there's various niches that you need to take advantage of. I mean, there's ethnic markets. I mean, the ethnic population is really where most of the national publications say the most opportunity is. You have to be able to manage a variety of different people. I think if you have an office of 20 loan officers and all 20 are the same personality type, it probably isn't going to work long term. You really have to understand how to manage, a diverse originations group.
Along that ethnic line, you kind of pricked my interest here. I remember going back, a woman in my office that worked for me years ago, and she was one of the very early people that concentrated on the Korean market, and she was Korean herself. And it was amazing. She used to advertise in all the Korean publications, went to all the meetings and everything, and it was incredible, not only the amount of loans that she brought in, but the sheer volume of each loan. These people were putting money under their mattress, and they had tons of cash. They didn't believe in banks, but when the time came, they could put 30% down, and it was just riveting watching her. And I agree. I think these are the markets. You're seeing some companies now, at least from what I'm reading, really almost setting up separate departments to work with the Latino community and the Black community and a lot of the other ethnic communities, because they've come to realize that that's good business.
Yeah, our real opportunity with this Republic acquisition is exactly that. In downstate New York, if you've ever been in New York City and the boroughs of New York, the ethnic
mostly the Plaza Hotel with the Oak Bar,
are abound. Southern Florida, where you have an awful lot of South American immigrants coming into the country. West Coast, where a lot of Asian Americans seem to be residing. Those opportunities are really there. The opportunities are limitless, and I think everyone knows about them, but how do you really take advantage of them? How do you develop products? How do you work with your secondary marketing partners, your mortgage insurance partners, to develop products and programs to provide outreach to those communities? That's the difficult part. Everyone understands that there's 20 billion people in New York City. How do you get to that population? It's not your traditional secondary marketing lending.
Right, exactly. You mentioned earlier that your company, the philosophy is more of delegating responsibility rather than micromanaging, which leads me to a question, and that is, how can you delegate and yet at the same time hold people accountable in the sense that you're not on top of them day to day, and that micromanagement.
You have to trust people. I mean, you have to spend time, and certainly there's formal evaluation processes that we have in place here. There is certainly my style is very informal in a lot of cases, but I speak to most of my managers almost on a daily basis. I know them personally as well as professionally. It involves some trust. I mean, you have to be able to give people the ability to make decisions and at times to make mistakes and allow them to learn from those mistakes. It's impossible to micromanage if you look at a company our size with an excess of $6 billion in fundings, with 3,000 correspondents that can deliver loans to us in the combined organization, with 200 loan officers and the various relationships they have. It's absolutely impossible to micromanage. If you did, there wouldn't be enough hours in the day.
Yeah. Tangential to that, let's talk about morale a little bit. How do you maintain morale within your organization? And here I'm not just talking about loan officers. They're very self-motivating to a certain extent. Give them the right product and give them the support, and they're out there, doing the deal. But what about your other people, the processors and underwriters and the shippers? And
I think part of the I mean, the easy part of that is that in this whole acquisition and merger world that we're living in today, we've been on the right side of that equation, which gives people a little bit of a comfort level. The fact that they're with an organization that's growing, and that's just a byproduct of what the group has been doing over the past several years. That we've been expanding our presence throughout the world, and now particularly in the United States, where we've had several acquisitions in the last 3 or 4 years. So part of that is easy. The other thing that we're involved in right now is something called the Mortgage Capacity Expansion Project, and it's really a grassroots project where we're utilizing one of our mortgage insurance partners to help us really devise an entire workflow process around automated underwriting and those automated underwriting engines. And we've been at this for well over a year now. It's not something that senior management decided one day that we ought to do. It's a philosophy that we've discussed, and we basically put it into the hands of the employees in every business unit in Mortgage Corp, from originations right through to servicing. And those individuals in each of those departments have been involved in this project in one way, shape, or form, and they're developing best practices, and they're finding out the rework and the duplication of effort and the inefficiencies, and they're making recommendations as to how to improve efficiency, morale, profitability, et cetera, and that's really kept a lot of people kept their attitude and helped boost their morale. They feel like they're building the business or the process for us, and we're allowing them to do that because they know best.
I think I have something that some concurrence there from once again from Scott Cooley, and that is that in his research for some of the articles that he writes, he has looked at some of the internet companies, and one of the great fallacies that he finds with these companies being able to outprice the regular brokers and mortgage bankers out there is the fact that once they take that app, they still got to process it.
Sure.
And they got all the back office, and they have everything that normal companies do. And when you combine that with the fact that their cost of obtaining business has risen dramatically now. As you know, it's much more competitive, and the easy days of just scarfing people up and throwing one name out like E-Loan and everybody knows it. It's a lot harder for an entry right now. As some of the internet retail companies, as you know, are finding out much of their chagrin right now. Let me ask you something on a personal level. How do you release from the normal pressure of the position? And first off, that begs the initial question, and that is, do you feel pressure in your position?
I think so. Certainly, I think it's difficult to really be successful in this business if you don't live it, eat it, and breathe it. It becomes a large part of your life. You become friends with the people you work with. You become friends with the people you conduct business with on a daily basis. So I think if you've been into this business, and I've been doing it since I really graduated from school, it's almost impossible not to feel pressure and not to live the business on a regular basis. I'm really an optimist. I think that whenever times are tough, whenever you feel like you're finally ready to throw the towel in, you're just about around the corner is a huge opportunity or a huge success that you're about to celebrate. And I think that the years in the business have taught me that, not to get too high or too low, but certainly there's stress, and there's stress in anything that you do. And I think stress comes from the fact that you enjoy doing what you're doing and you live it, and life isn't easy.
Right, exactly. I'm going to take just. When it comes to morale, do you find that that dealing with processors and underwriters and shippers that this is a real tough area for an organization? And I say that because with loan officers out there, they really measure a company by the support they get. There's nothing worse than for a top producer to have to share a couple processors, and when he's bringing in the volume, and the shipping can't get out, and the story.
Sure.
Just wonder if you could comment on that and what you do to keep the morale up of these people.
Well, again, I think part of what's kept their morale up is the process of change that we're going through right now. What we're attempting to do, John, is really blur those lines and break down those walls between processor, underwriter, post-closing, quality control, shipping, all the various back office functions, and all of our people are going through a certification process so that they'll be able to handle a loan from registration through post-closing. Mm-hmm. And I think their morale is impacted by the fact that they're learning new tasks. Again, it's not easy, and some people don't want to change, but some underwriters don't want to input a loan. The old traditional underwriters feel that inputting a loan is beneath them. Some post-closing people don't want to deal with the closer in operations. They want them to contact the settlement services agent, and they just want to sit back and wait for that file to get to their desk, and then they'll pass judgment on it. So the change process we're going through has helped, again, to repeat myself from earlier, has helped morale dramatically because people are being cross-trained, and they're really learning pieces of the business that they didn't know before, and they're learning that the business isn't as complicated as maybe they thought it was before. Mm-hmm. I think that's really the way we're dealing with it today. We've never really assigned an individual underwriter to individual loan officers. We're really structured along geographical lines. At some point in time, we've been structured along specific products, but now that everything we originate is going through some type of underwriting engine, some type of automated underwriting engine, and we're getting similar output from that engine, we've really gone back to a geographical orientation in the back shop versus a loan officer or a product owner.
Might have any great victories or great defeats, regrets or lamentations?
Probably. Again, I think this business, for the most part, even going through the various changes that we're going through with automation, with profitability, and selling multiple products, and talking about all the issues, I think that are really facing the industry today, I still believe that deep down it's a people business, it's a relationship business. I think the companies that really understand that and that attempt to utilize technology to enhance relationships are the companies that are going to succeed in the future. I don't think that you can lean any one way or another. I don't think you can throw the computer out the window and get back to pen and paper, and I don't think you can rely specifically on the technology to bring business in the door, because I don't believe that.
Ready to hear you say that.
I think you have to combine the best of both worlds.
Right.
You have to realize that you're going to make a few mistakes along the way, and you've got to be optimistic, because I still believe, again, it's a people business and a relationship business, and that's a good thing. That's fun.
Well, I think this is a good point to wrap it up on a high note. I want to thank you, Larry, for taking your time to talk with our listeners. I think it was very valuable, and we'll certainly keep you in touch on how things are going. And again, thanks.